Hey everyone, welcome back to the MHP Show podcast. I'm your host, Derek Vickers. And on the MHP Show, you guys know we're talking about mobile home parks, manufactured housing, managing operations, raising capital, anything about the business. And I got a complete stud with me today. I got this Mr. Hansel Rodriguez. I got a lot of respect for this guy. He's doing big things. He's done big things in the past. And I'm super excited to have you on, man. How many podcasts have you done? Is this like first? Like nothing you haven't done? How many have you done?
This would be number two. So
Okay.
Andrew Keel is number one, and that was a lot of fun. But no, I can't say I'm as good at this as you are.
Well, I think you'll do just fine. We always have great conversations when we talk, and so we'll get into it, man, and we'll have a good
Yeah.
time today. So again, thank you for coming on. So give us a little bit of I know you have a pretty impressive background and some things that you've done before. So kind of get into that and explain what your experience is.
Yeah, I mean, look, my short career has been, doing working on the deal side of the world. So at first, starting with companies, helping companies buy companies, that sort of thing. I got into manufactured housing actually through someone you probably know very well. Ryan Norris was nice enough to literally take like 2 hours of his day to be like, "Hey, this is a mobile home community. This is how you collect rent. This is how you do all these things." And he was when I was working at a bank up in New York, like he basically taught me the business. So kind of push come to shove, now we've grown into a larger company, but it's all the same, right? I mean, it all always was. You find opportunities, you raise capital, and you do the best you can to execute and avoid risk, right? And so now we've grown to 25 communities across 9 states. We have a great team of 34 people, and it's kind of beyond what I would have initially thought would happen. So, yeah, I've learned, still learning a ton every single day, but it's been a really exciting journey for the last 4.5 years.
Yeah, that's awesome, man. And so you had it looked like your a lot of your background. I know we had talked a little bit before. Was it
Mm.
like you said, so some larger transactions like private equity, sort of a Wall Street background, correct?
Yeah, yeah, that's right. I mean, and it evolved, right? Like I actually started in real estate back when I was in college. I worked for free for a year to learn through a guy, Thomas Tapp, nicest guy. He took me under his wing, was like, "Hey, this is a low income tax credit deal. This is an apartment deal," and it was like the best experience I ever got, despite the fact that it was an unpaid intern. But that, one of the neatest things he told me was, if you really want to learn finance and how to do deals, you should try to find a way to M&A. And so that's where I spent the first 3 years basically helping publicly traded companies buy their competitors.
Hmm.
So some big names like Stanley Black and Decker. I worked on a deal where they bought Newell Tools. And they
Hmm.
bought like the Irwin brand out of Sears when Sears was divesting some of its business. So it's all, though it's different from real estate to companies, it's all the same, right? The dealing with the seller, negotiating an agreement, knowing the pain points and getting through them, and then the capital markets is part of it. So it was a big change going from that to this, but I find a lot of similarities in it.
Yeah, for sure, for sure. And how did you like? You were in real estate before, but what did you like? Did you stumble upon manufactured housing? Like, how did you stumble upon that?
I kind of. I mean, look, I started in single family when I was in college as a bit of a hobby, and so we were buying houses, flipping them, wholesaling them, doing what everybody does to get started in real estate, right? And that evolved. We did about 40 homes in that business, and then when I was in on the advisory side with investment banking, then I really didn't have much free time, so I was just helping them finance their deals, and as this is all like a passive hobby, but when I got into banking, what I really liked was that they really taught you, like, oh, what is an annual report? What is a real estate investment trust, right? And so I would, in the late hours, I would just read the different REITs and what they were buying, and I kind of came across Sun and ELS, and I understood the business plan. I really liked the fact that mobile home parks, they're very defensive sectors. They had basically grown rents and occupancy have been stable since like 92. There is no other category of real estate that does that, right? I
Right.
thought that was super attractive. I also thought it was easier for a guy who had never been, in an enterprise like that to go in, right? Like if you go into apartments, everyone you compete with is highly institutional and super competitive. In our business, you're dealing with families, They're private transactions. I just felt like it was easier for a guy who's like first generation to go to college to do something like that. And that's just kind of how it worked out. And so now it's become something where it's larger scale. We're buying larger assets. We have a really good team, but I kind of just fell into it, reading the different reports, and again, thanks to guys like yourself that do all these podcasts and stuff. I would literally listen to Kevin Bob, Ryan
Yeah,
Norris, the Frank and Dave podcast, and all that. That was like the Bible at the time.
for sure.
So yeah,
Yeah. Yeah, that's awesome, man. And I kind of stumbled on it the same way. Just, I wanted to get in multifamily. It was the same thing with you. It was like the barrier to entry was much higher, and
right,
it was more I couldn't, in the beginning, a 20 or $30 million deal. I just couldn't fathom raising 8 million bucks for a deal
right.
at
But
that
you've done it though, Derek. That's the thing, man. I mean, I joked with you when we first met. I was like, I feel like I know everything about you, and I've never met you.
point.
Just through the podcast stuff. I mean, I'm kind of curious how you guys have done so well too, because I mean, it's really impressive, man. You can't say you're some random startup anymore. Like,
No, not anymore. Obviously it was a factor of the market, and we found
yeah,
like a little wrinkle in the market where, like, if a seller, back in 2021, sellers had a number in mind, that like
right.
FU number, like hell yeah, I'll sell. Figured out
Yeah,
that we could pay that number and create a lot of value out of that number. So just imagine now, it'd be like going to offer, you know, whatever that number is to every seller, which is much higher than it
yeah,
was in 2020. So, like,
right.
we would make an offer, get a deal, make an offer, get a deal, make an offer, get a deal, make an offer, get a deal. And the deals ended up being like home run deals. And so it was just, a crazy time. And yeah, it's been a wild ride for sure. But yeah, I stumbled across the business just like you, because I couldn't. It was difficult for me to think about raising 8 to 10 million bucks for an apartment complex. So we had to start with that the first 20 unit deal, and then kind of build up from there. And
Right.
it's a pretty interesting business. I would have never imagined, being, where we are now. I mean, I would have imagined it a little bit. So I probably did think about it to a degree, but not
Yeah.
as like fast and sudden as it was. So, um, but you guys have grown, and now you're buying bigger stuff. But what was the first park that you bought?
First Park was like a small $500,000 deal. I partnered with Corey Woodruff of all people. I'm sure you've met him. Wonderful guy out of Michigan, or I guess Ohio actually. But I was still working up in New York, so I didn't have the time to do the operation side. And Corey was like he was actually selling mobile homes. He had been a mobile home dealer before, had wanted to get into the investment side of it. So we partnered on a deal, and it was just an opportunity where there's a lot of value on the rent growth and a little bit of occupancy. And so it was the first deal, found an investor, did it. And then that kind of, after that, I was like, Corey, we've got to buy more. It worked out. It was a really good deal. And also too, I mean, it was the perfect deal too, right? Your first deal, you don't want to take too much risk. The seller financed it and they were really nice. We got them paid back 3 years ahead of schedule. That I don't know that I would have had the courage to do. Like, our second deal was the opposite. We had to buy it all cash. You couldn't finance it because of some of the complexity in the deal. So it was like the perfect first deal.
Yeah, yeah. How many deals did you guys do together?
Corey and I did, well, we did probably three together. And then he wanted to grow on his own and he went out to do his own thing. And I've heard he's bought a ton of communities too.
Yeah,
But so the thing about Corey, they are very focused in the Midwest. Our kind of strategy has always been Southeast, Southwest. We want to kind of follow population growth, employment growth. We just want to be in the markets that if you wanted to hold for 30 years, you're not concerned about what might happen to Detroit or Dayton, Ohio, places that have unfortunately had really bad population decline. So it's just a difference in strategy.
yeah, yeah. And I love that, because I have the same strategy. I believe in, paying more for a better location because of the population migration, and you don't have
Yeah,
to worry about that. Like, time's going to be on your side. So even if you make a couple mistakes, time is going to save you, and you don't have to worry about that stuff happening.
100%, and that's the biggest thing, right? So for us, particularly, we're not terribly obsessed with selling. Like our goal is actually to hold very long term. And so if you think about that, right, you can't change jobs to Detroit, right? Like
No.
you can hope, you can influence, you can try to lobby maybe if you're very one of the fortunate ones out here, but you can't change that, right? So whereas Florida, and you know this better than even me, you've got jobs, you've got anybody you talk to in the Midwest either wants to have a second home here, they want to permanently move if they can convince their family. I mean, I was in New York before I moved to Florida, and I'll tell you, it's like every other conversation is like, oh, how do you like it? Like, would you recommend it?
Yeah.
Why did you come back? Right? And that's not even including all the jobs. I mean, I'm in Miami, so we've got all this crazy talk of these big banks coming down here. A lot of tech that Suarez did a really good job of trying to convince kind of the legacy Silicon Valley, San Francisco headquartered companies. Hey, come on down to Miami, right? We'll work with you. We'll encourage you. There's some challenges around schools and stuff, but they've done a really good job of saying, come on over. We'll do what we can to accommodate you, which is kind of the opposite of what you hear in those states currently. So, yeah, I think for those reasons and many more, man, Florida's not going anywhere. And I say Florida, like Texas, Arizona, Albuquerque, New Mexico, of all places, that has a lot of transplants from California that want to stay somewhat close to home, but they want to live in a more moderate climate and in a more business friendly environment. So yeah, I can go on and on. I mean, we're pretty obsessed with that strategy.
Yeah,
So
yeah, and I love that too. And like if once I decide to start venturing out of Florida, when I think there's still a lot of opportunity in Florida. And do you
there's
think it's
tons. Yeah, I would agree.
do you think it's easier to raise money for those deals versus this deal? Oh, it's a 10 cap, but the population's 5,000 people.
It's that's a good question, actually, because that is a very good question. I will say my opinion, but it is not the answer, right? Because you know it as much as I do. I mean, there are very good guys that are turnaround guys. They'll buy a 60% occupied park, they'll get it to 85%, but it'll be somewhere in Kansas you've never heard of, right?
Yeah,
And I don't think it's a bad opportunity. It's just a different strategy.
yeah,
So for my personal opinion, those guys are operationally intensive. They're successful because they execute on that. Whereas in our world, we're buying minimum 85% occupied, if not 100% occupied, right?
yeah,
So our view is we want to take less risk on operations. We want to grow a large business, but we want to be in markets that the tailwind terminal growth is 5%,
uh,
right? And if you grow your NOI by 5% for 5 years, what does that mean? You've increased the value by a minimum of 25%,
yeah,
right? And in 5 years, right? And so it's just a different strategy.
yeah,
Like, and then you look, I'm not that smart, right? Like I just follow what the biggest capital allocators are doing. If
mhm,
you look at the biggest private equity firms and investment firms, they don't want to buy in California for housing. Not because there's enormous shortage of affordable housing in California, but it comes with the political risk, the rent control risk, the negative business friendly environment risk, and it's a debate. I'm not going to say that that's a permanent view, but there's risk around that, right? Oregon,
right,
Seattle, places like that. I mean, it's every single day you hear that there's a risk of something like that. New York, even too. So in Florida, just the opposite, right? There is a very business friendly, arguably lower property tax environment. Not to say it doesn't come with its own risk, right? We have climate change risk in Florida. That's a real thing. We have to underwrite every time we're in near the coast. In Texas, you have hailstorms, right? So everything has its own kind of caveats. But from a just absolute growth in real estate, you bet on growth. Like you can't. I don't think you can do better than Florida. And to your point, is it easier to raise money? I think yes, right? But I always tell investors, it's like, okay, when you buy a mature company, you better hope it has a good dividend, right? Because there's not that much growth left, right?
right,
In our Florida markets, you might get a 5% dividend, which is arguably lower than like our competitors out in the Midwest that are doing 8-10% cash on cash. But guess what? You're growing 8 to 10% in value a year
for
in
sure.
some of these places, right? I mean, in South Florida, we saw growth in just NOI at 30% simply because of the amount of people, 200, something like 200,000 people moved to South Florida during COVID. You know what I mean?
Yeah,
There was not enough housing for that many people. So
right.
it's just, I think it's like you have to be able to tell investors your dividend is lower because the growth is higher long term in these markets. And they have to understand that. If your goal is just dividends, there's absolutely better places to go than South Florida. Like that would be a tough place to do that. So
Yeah, for sure. I don't know how you buy anything in South Florida. we had the opportunity to buy this junk deal down there for like a buck 20 a pad a couple years ago, and we passed on it.
Yeah,
Now they're trying to sell it for like 200. It's a total development play at this point. I mean, you can't,
yeah.
you can't
You're not wrong. You're not wrong. It's actually, and it's really unfortunate. We've bid on almost every deal that's come out in South Florida. We did buy one at 100,000 a pad, one of our best investments. We
Oh,
literally were able to jump.
I'd buy something in South Florida for 100,000 a pad right now and start
At the
heartbeat.
time, it was one of the highest price per pads in the market, though. I mean, it's just now 100,000 is not even like people don't even like they would. That's a
Yeah,
slam dunk, right? Like
yeah,
at the time, I think we were the second highest price per pad paid. I think in that 3 year span, right? So like, but anyway, but the point is, you're right. You're actually exactly right. A lot of the deals that we couldn't win were actually bought by developers. They're going to go in, tear down the mobile home park, re-entitle it, right? Because like a mobile home is doing seven at best, maybe 7 units an acre, and they're putting up 25 to 50 units an acre,
yeah,
multifamily. So unfortunately, like, and I tell people all the time, like, if we're going to buy it to keep it a mobile home park. So yes, can we pay you the same value pound for pound as a developer? No, but your tenants are going to stay there. We're going to run it as a mobile home park. We're going to support the affordable housing mission in South Florida. But as we all know, sellers have big decisions to make in that. So
yeah, yeah. Where do you think, as we, when I got in the business in 2020, I was talking to some people that were, buying in the Carolinas and stuff, and they're paying, 20, sometimes 15, 20, 25,000 a pad. And I had deals in Florida that I was talking to somebody for 50, and they're like, oh, you
right.
should never buy that. This is a covered land play. And I'm like, now I'm like, fuck, I should have bought all those deals. Like, I shouldn't have listened to this idiot. Guy's not an
Yeah,
idiot, though. Guy's a smart guy. But just, I think, like, in the real estate business, you see these
yeah,
old dogs come in and they get stuck in the time that they came in the business, right?
right,
So the people that back in 2020 that were stuck at the 25, the 20, 25, 30,000 a pad, it was harder for them to transition to the 50,000 a pad, which was like actually a good deal in 2020,
right.
2021. And so
Yeah,
now you see the shift again where people are like, oh, 70, 80, like, damn, I can't do that. And I'm sometimes like that, but you also have to be forward thinking. And I'm getting to my
yeah,
question here is that where do you think where do you think the price per pad is going to go? I mean, I think me personally,
yeah,
dude, I think we're going to see. I mean, we already see 150, 150 and
yeah,
200 for the higher end stuff, but it's a product of your NOI and cap rates, and that's going to continue to increase. And so I think we're going to see big numbers. But I'd love to hear your opinion on that.
I mean, I think no. I actually think my opinion is just like yours. Look, I think the old school guys, if we call them that, it's just you got to be plugged into the market, right? And
Yeah,
so, to me, real estate is a premium. You make a premium to treasury bonds, right? We're all always compared to where debt yields are, right? And so, if I were to say something like 80,000 a pad is not, is expensive or cheap, to me, like the price per pad is relative. Like, okay, think about, so we bought a deal, that 98,000 a site deal in South Florida. At the time, people were like, you guys are crazy. Like the cap rate's crazy, blah, blah, blah. Now to your point, 150 a pad, like all day. You know what I mean? And
yeah,
so,
yep,
and you're lucky to get your hands on it. Like people would be fortunate to get it. And
right,
so, but the thing is, what people didn't understand back then is like, okay, we saw 30% growth in South Florida in 1 year on rents in multifamily. We had 200,000 plus people move in 1 year to South Florida, right? So actually, that was a stat for all of Florida, not South Florida, but a lot of them did go to the South Florida area. So that's the misunderstanding. And
yeah,
so if you weren't plugged into where the trend was going in that year, of course you would have been like, I could have bought. And you looked at the comps, even for us, it was tough to justify initially because everything was like 50 a pad in South Florida, call it 5 years ago, right? And
yeah,
so to me, it is a function of rents and home prices. You look at the U.S. average in home prices today; it's 450,000. So is 100,000 a site crazy? I don't know, right? I would
yeah,
argue probably not.
yeah,
You're still 4.5 times cheaper than your single family alternative, and unfortunately, that doesn't seem to be reversing in any way. And we've just had interest rates go up to 7% for a mortgage. You know what I mean?
yeah,
So if that didn't bring it down, then please, like, what will? And then on the rental side, I think that's the more difficult part for people is just it's all a function of rent, right? So even in multifamily, I have friends that work at some of these big, multifamily groups, and they're like, yeah, people used to think like 120 was crazy for multi. Then it got to 150, then 200, 250 for premier, West Palm Beach markets. And it's just like at the end of the day, but it's also relative. Where are rents, right? The higher the rents, the higher the NOI, the higher the relative price per unit. And again, in real estate, we always talk about replacement value. Whereas in multifamily, you can literally say, I can actually build that multifamily building for a certain price per unit. How can you do that in MH? You know what I mean? Like that's what I think people don't understand. You cannot build it. Cities
Yeah,
will. It's very difficult to get entitlement. To your point, if anything, they're buying it to redevelop it into something else. So, is there really a perceived high value price per pad? Because you can't recreate the infrastructure and the location. So, tough answer. There's a lot of answers to that, but my point to you is I don't think there's a ceiling to that. Unless Lennar can go out and build a house for 50 grand with the land, right? I think we're insulated for many years to come.
yeah,
So,
yeah. I agree. I agree. And it's interesting when you say that you have to be plugged into the market. Like I
yeah.
couldn't agree with you more because if you look on like best places and stuff, the average rents for different MSAs I think is based on a 2020 factor. So even the stuff in Florida,
Oh wow, really?
like the compression of population and the migration was happening even after that, right?
Right.
So unless you're plugged,
That's an interesting point. Actually, no, I'm curious. Wait, so what systems all the way back to? You mean like census?
not census, but on best places, I think the last time I looked on
Oh, that's right.
stuff,
Yeah. No,
it
you're
was like
all that
2020.
stuff's stale. Literally, I mean, it's funny now to think that Zillow is probably one of the most efficient marketplaces for information, right?
I know,
But the thing about Zillow is like it's daily. You're seeing that daily activity of
right?
people going in, organically selling, renting, pricing assets. But yeah, you're 100% right. I mean, it's crazy how quickly these things change.
Yeah, yeah, yeah. And it's funny. I hear people like talk about. I think someone posted on my Facebook group the other day. They were like, "Hey, I heard that," and I've heard this from numerous people. Like, "Hey, you can't buy
Right.
parks in Florida. I heard don't buy parks in Florida because you can't get insurance and blah blah blah." I'd love to know your
Yeah.
your experience with that. Are you having
Yeah.
issues with insurance at all?
No, insurance is definitely look, I mean, if I was to name the top two biggest risks to Florida, right? So you get all this, on the positive side, you have all this growth, you have all this migration trend. It's a highly desirable place and tons of jobs also supporting that. But the downside, climate change is very real. We literally get climate reports now, which it's not even a political issue. Like we can debate the politics of it all day, but from a investment perspective, flooding has happened higher at a higher frequency than it has otherwhere, not only in the same location historically, but also like relative to other places in the country, right? And so that's a real thing. Hurricanes, real thing. So when we go in, we'll quantify all that stuff, and insurance is the biggest thing. I mean, we will literally price insurance at acquisition, like in our due diligence period, to truly know where it is.
Right.
Um, but to your specific question, I think it's a relative risk. There was a year when we had that record year of insurance incidents. I think it was like over. I forget the number, but it was like the highest year of casualty for insurance and property. And I think Florida led it, second only to. I think first was Florida, second was like California or something, if I remember that right. It was a tough year. We literally could not get insurance in some of our properties. We saw premiums go from like 10 grand to 100 grand. And we convinced lenders at that time to say, hey, we would rather self insure. Like the payout of the insurance is only 2x that. Why don't we just hold that in reserve and
Right.
we'll self insure? And so I think to me, the yes, insurance is a risk. What's the solution? Well, at the end of the day, we're landowners. We're not buying assets with too much inventory where we own the units. And so the downside case is you just have to be your own insurance policy and have cash set aside for that bad day. Is it dilutive to returns? Yes, a little bit, but you can manage through it. And then what someone made a good point to me was that insurance markets are like all markets, right? People will price it to bring in supply again. And so the point being, premiums were 10,000, so it was a little too shy for the risk that now is perceived in the marketplace for insuring a mobile home park in Florida. Well, what happened? Then they shot up to 100 grand and nobody insured. They were all like, you know what? That would blow up our loan sizing, that would blow up our debt service coverage test. So we'll just self insure. Guess what? Now insurance, like on that same asset, is probably closer to 25,000, and we just re-upped insurance with an insurer.
Yeah.
So I just
What are you
think,
talking
and
about? Are you talking about like, I mean, are you talking about business loss of income insurance? Is that what you're
exactly,
talking about?
exactly,
Yeah.
yep, 100 grand on like a 80 site community. Could you imagine? I mean, that's like, yeah, a year was the policy quoted at that time. I mean, but this was, this was in the throes of like everybody had a brutal year, on unfortunate losses with there was the fires in California, it was the hurricanes in Florida, there was a bunch of hailstorms that hit Texas and stuff like that. I mean, it was a tough year for insurance, and so they basically walked away from the market. And then when we went to our lenders and said, well, we think this is a little overblown. Like, let's just go set aside, 2 times or 3 times the payout of that insurance in cash. What's a better guarantee than cash, right? And they gave us some very unique structure to basically get that cash out if insurance came back, and thankfully insurance came back.
Yeah.
So,
Yeah. And
so
so,
I think like all risk, you just have to underwrite with that risk in mind here.
yeah, for sure. And so moving forward now on deals, so are you guys getting loss of income insurance or are you self-insuring for that?
Yeah, no, we're getting it. We're getting it on every deal, so far. Now, are we going to buy a Fort Myers waterfront mobile home park? I know there are groups that'll do that today. They think there's good value in that. I don't know that I have the stomach for that per
Right.
se. But if we're 20 miles in from the coast and we're in a good urban infill location, we'll do that all day, no questions
Sure.
asked. And if we have to self insure, we'll set aside the cash and underwrite the returns that like we've done that. We've the loss of business income would have paid 100 grand. Maybe we'll set aside 200 grand for that payout, and we'll set it in reserve, put it in a treasury market account. And if that bad day happens, we have that same coverage without having to pay a high policy if there isn't any insurance. But I'll be honest with you, we haven't had that experience yet.
Yeah, yeah, right, right, right. And so you'll actually look at it as like, hey, this policy would have paid out this amount, and then you're throwing that in your underwriting as like a reserve um,
Exactly.
expense.
Exactly.
Hmm.
Yeah,
Interesting.
and I think it's well, think about it, right? So there's two ways to think about it. The problem is insurance. Even if you wanted to pay the premium of 100 grand, well, what does that do to your deal? Now you're paying 100 grand in insurance line item. You're now underwriting that deal with 100,000 of NOI drag
Hmm.
because of insurance expense. So now your loan sizing gets messed up. I mean, like we did this with the largest lender of mobile home parks, and they were like, they even thought that was unreasonable, where they said this is a temporary blip, we know that the markets will come back, and they did, right? And so thankfully, like in partnership with the lender, they agreed with us. Why would we set aside and impair the value of our asset by so much when we could just set aside the cash? And we also underwrote, if a buyer was going to buy it tomorrow, would they do the same thing, right? And the argument was, yeah, of course, because, and this was the bottom. This was like when there was no insurance, right? So if you think worst case scenario, that's as bad as it could get. What's the next buyer do? Well, he's probably going to set aside the same reserve, and then the same bank will be comfortable financing him at the same leverage level. Everybody kind of solves that same solution that way.
Right, right, and yeah, and I mean, I think that's a very smart way to do it because you're still looking at the worst case scenario. If you're buying, 20 miles plus inland, you're not in a flood zone
Exactly.
in Florida.
Yep.
Really, in my opinion, like the main risk that you have is wind. And if
That's right.
handle your trees and things in your parks, you do a lot of tree work in the beginning, which I do. I
Yep.
bring CapEx for tree work. If we've got trees and crappy trees that could be an issue, we take those down
Right.
in the beginning, or take take the risk out of them falling on a house.
You're smart to do that. I mean, it's expensive. I mean,
It's
you know
so
that,
expensive.
but but think about the liability, right? And don't get me wrong, we do that too. It's so important. It's so short sighted, like how some guys won't do that. But the reality is, I mean, the potential risk that you can harm somebody, a hurricane. It doesn't even have to be anything crazy. It could just be a 50 mile per hour day could knock a dead tree over and stuff.
And
So
that
you're
happens
you're
like that happened in Orlando yesterday. Like
did it? Yeah,
not
that's what I
even a
mean.
hurricane.
Exactly. Oh my god.
Yeah.
Yeah.
Um, yeah, it's interesting because I think like even with I think it was Hurricane Ian that came through Fort Myers, like we had, some porches, some awnings blow up, like porches blow off
Exactly.
roofs, but it wasn't anything. crazy. And if you look at some of these deals in Florida and even some of the stuff that you're buying, I mean, how old are some of these homes in there?
They can no, they can be really old.
They're old.
Absolutely.
So
Yeah.
how many, if they're a 70s home, which a lot of stuff in Florida, the Florida special is dense, older homes, right?
Right.
You know, how many storms have they been through in 40 years, 50 years?
And that's such a good point. So it's funny. We like I said, we do all this crazy analysis to get comfortable with the risk of hurricanes. But one of the simplest things that someone said to me, when actually, Ricardo on our team is a super talented guy, and he's like, "But wait a minute, these homes have been here since '64." You know what I mean? So like how and I will say like there's an argument to be made. The past is not the future when it comes to a
For sure.
hurricane, but there is something to be said about the fact that these homes have held up through almost, call it, I mean, at least 80, 70 years in some instances,
Yeah.
and they've held up
A storm or
impeccably
two a
well.
year, like that's
Yeah.
over 100 storms, right?
We had a property in Bonita Springs, Derek. Scared that hurricane that hit Fort Myers scared the crap out of me, right? Like we were right there. And you remember that hurricane was supposed to go to Tampa, but it ended up
I was
diverting
scared.
to Fort. Oh my God. So, and here's the crazy part. So we were lucky because again, we followed that. We want to be a certain level of inland and all that. The storm lost a lot of power once it got through Fort Myers and hit inland. But the crazy part, it was the wind. The wind hit some of the center parts of the state and caused some damage to the homes in places you would have never thought of. Like Sebring is in the middle of the state. Like I'm talking like in the middle of the Everglades is this little town called Sebring,
Yeah, yeah,
and it got wind damage from that hurricane.
yeah,
Um, but to your point, it all worked out fine because even though they were slightly older homes, they just held up, and so a couple little things where bushes and stuff got impacted, but nothing material.
yeah, yeah. And if people ask me all the time, and when I'm talking to investors, they're like, "Well, what's your thesis on the hurricane risk?" And it's exactly what we just talked about a second ago. I
Yeah,
talked about that and how we avoid that. I'm not buying in a flood zone in Florida, and
yeah,
and we can talk about that in a second, but it's I'd be lying if I said I didn't get a little like when the hurricane was coming, when Hurricane Ian was coming, they're like, boom, it's hitting straight Tampa. I'm like, oh shit. Like,
yeah,
you know, little scared, but we ended up being okay. And
yeah.
to your point, like the center is like in the middle of the state. I mean, Orlando is pretty central, and
That's right. Yeah.
we had some wind damage in those parts.
No, and you can we because we've gone so far on it, but there's you believe it or not, there's actually an incredible amount of data. So you can actually predict like we the riskiest deal we ever did in Florida statistically was like there was a 20% chance that over the next 50 years a severe storm could impact that community. And there's actual weather data that will tell you based on historical data and their forecasts. I think it's like the National Weather Service. They do forecasts on how these things could change. You
Mhm.
can statistically quantify what the risk is, right? And then what we decided was like, okay, 20% over a 50-year period. Well, we think we will do a healthy refinancing within the first 3 years or 4 years of that property. So, from an investor perspective, capital's back, right? We can't predict the future. We don't know the unknown. These are just numbers, right? Numbers
Right.
give you this false sense of security, but like tomorrow we could get smacked with a hurricane, right? But like the numbers are in your favor when you're thinking about a pretty short horizon. And then what we do always is like, okay, if we are going to be in an area that has a risk like that, well, we need to have more cash set aside, right? Because as you know, we just own the land. So God forbid, worst day, community gets completely impacted. Well, what do? Now you get financed. You go bring in a bunch of brand new homes. If anything, you just improve the quality of your community. You have that working capital, and now you lease it up to brand new homeowners, right? It's not a loss. So, and people, if they think of it like multifamily or single family, they don't immediately think through that. But it's not necessarily a bad thing. I mean, in some instances, we'd have a huge mark to market opportunity on rents because now we're bringing double wides in the community. Brand new, high quality, like 1,400 square feet, 3 bed or 4 bed, 2 bath units. And so it's all subjective, right? But you got to know for us, it's all about how soon do we de risk our investors from getting their money back. And then truly, like, what is the risk of an event happening? And to your point, the more inland you are, it's almost not even a risk. I mean, though storms will hit Orlando, it never hits it with strong enough strength to cause the kind of damage that you'd have on the coast.
Yeah. Yeah. I mean, there were some places when Ian came through in Orlando that flooded pretty bad.
Flooding is different. Yeah, flooding. I live in fear of wind. Flooding is a completely different thing. You're right. Like
Yeah.
flood zones, we rarely actually. I think we've only taken the risk on flood zone once. Like that. That's a whole different animal.
Yeah.
Yeah.
Yeah. I don't. We were going to get an RV park at the beginning of this year in the flood zone, but I couldn't get comfortable with it. I couldn't, I wasn't,
That's a real risk. Yeah.
I couldn't go. I was talking to some like, some investors about it, kind of an early, my early look guys. And I couldn't, plus there was a zoning issue at this place, but,
Yeah.
I couldn't like convey it. Okay, if I'm raising money from you, Hansel, I didn't feel like, hey, this is in a flood zone. I didn't feel
Yeah.
like that good about it. So that was one of the reasons why I backed out on it, and plus the zoning issue. But there's people that don't give a crap about that. Like
Yeah.
if you
No, listen.
if you look
The
at even
people have.
some of the big guys like Sun and stuff, if you look at some of their nice stuff, fucking right in the middle of a flood zone, and I'm like,
Well,
okay,
some of that too. I mean, for to their defense, though, like some of them, they've bought those communities, and then FEMA has updated their flood maps. In
true,
as things
true,
have progressed, like FEMA will come out and say, okay, we didn't think this part of Florida was that susceptible to flooding back in like the '80s, but then when the 2019 map came out, I'm saying 2019, but they do it at whatever frequency they do it. They thought it was a higher flood risk, right? And so it's there. I've seen that a couple times where we're like, well, how did this happen? Like that's a pretty big risk, right? Because you got to worry about the financeability of an asset like that. But that's usually a lot of times that's what's happened, and so it's you're just kind of stuck with like, oh, now I'm in a flood zone. God forbid,
yeah.
like wouldn't be a fun day.
Yeah, no, definitely wouldn't be a fun day, and I avoid those at all costs because Florida and flood zone, it's like you're just
Yeah.
you're dipping your toe, you're playing with fire there, in my opinion.
Well, have you done the ones though where if you do an elevation certificate, the homes are actually above the flood? Yeah.
I have looked at that. I have
Yeah.
looked at that because yeah, that's another point. That's another point because
Yep.
home, depending on how high, but it's usually 3 feet off the ground, so that makes a big difference.
Dude, that's what I love about real estate is like you can pretty much quantify the risk, right? So we've bought deals that are like there's a couple homes that are on the edge of a lake or something, and that falls in the flood zone partially. But then you can literally measure, okay, what does FEMA say? Oh, it could flood up to 2 feet. Our homes sit 4 feet. Let's just say that number, right? 4 feet above that elevation. So actually the home wouldn't be impacted, the ground would be, right? And so
Right.
things like that work out. But it is so specific. You have to literally underwrite it down to like the unit. Like, okay, where does this unit sit? Is it sufficiently above the flood elevation? And then if it is, then even the banks will underwrite it typically.
Yeah.
At least has been my experience.
Yeah.
Floodways though, you don't touch. Like
Yeah. No.
if there's a
No.
floodway, you run. Like,
Yeah.
yeah.
No. You get out of there faster than you can even think for sure.
Yeah.
So you guys you're doing funds now. Like you started,
Yep.
raising money. Like, do you remember your first capital raise and was it difficult?
Of course it was. Come on. What was yours? A piece of cake? It's a terrifying memory to even think about now.
Yeah,
Like,
I know.
yeah.
Yeah.
No, my first capital raise, I put three people together to give me like 15,000 or something. It was like, and I was stressed out all about it. It was such a big raise at the time. But no, I mean, I'll be honest, the even to this day, like I think raising money is definitely the highest responsibility, right? Like there are deals that I would have done personally that we don't do because you have to be comfortable justifying the risk to investors. We do all these crazy things. We put a memo together. We do all this crazy underwriting, and sometimes I get the question like, well, why are we doing all this if we have the decision and the discretion to invest on behalf of investors? And it's like, well, they trust us, right? So we're not going to shortcut our own process simply because it's more efficient from a time perspective. If someone trusted us with their money and delegated their money with us to go invest it on their behalf, right? I think as I evolved, we did 19 deals, syndicating, raising deal by deal. It became my full time job. I was spending literally like 80% of my day raising money, and I had one of the guys that helps me do that. I had a discussion with him. I'm like, this actually doesn't make sense. I'm spending so little time on the deals and underwriting. This isn't efficient. So that's why we went the fund route. And then the fund route is incredible, right? The way I explain it is that yes, it's cumbersome, it's complicated. You got to do all these kind of extra hoops to make sure you're protected from a liability perspective and that investors are protected. That being said, though, it's almost like a deal, right? So whereas in deals, you're looking at deals, you're underwriting, you go through diligence and closing, you're doing the same with fundraising. And so whereas before I had to wear two hats all the time, I had no predictability around that. I had times where like up until the day before closing, I wasn't sure if we were going to be able to close. Now it's like 6 months to 8 months is our longest fundraise so far. We will be raising money, right? That closes. That next 12 to 18 months, we're deploying capital. And so now I get to be really laser focused on raising money, educating people in the sector, all that. And then my team and myself will then transition to doing deals, right?
Yeah.
And so I think it's a natural evolution, right? I think it was the best decision I ever made. I don't think I would have been prepared to do it 2 years ago. But where we are today, like I just feel very lucky. The team that we have does a great job. They know the process, they know the steps, and so we're able to do it really well. And yeah, I mean, I recommend anybody that can do it. I think funds are great so long as you're ready to go and you can meet the challenge. I will say with fundraising, it's not so much raising the money. Like that is a challenge, but I mean, come on, like given what you've already done, I don't think that'll be a challenge for you. It is the deployment of capital. It is that pressure to
Mm,
say, hey, I'm going to go raise $25 million. Can I responsibly invest that in 24 months?
mm,
Right? Because like that for us, for example, that's our goal. So now what does that mean? That means you got to have a team that's constantly out there hunting deals down. You have to have the infrastructure to execute on those transactions without taking incremental risk, right? And then you got to match that capital as you're getting it in into deals. That is to me, that's actually what stresses me out because I am not one to I don't like to just buy stuff, right? And
yeah.
so I don't shortcut diligence just because we've got some pressure. But that is something that I can see why people will make mistakes because of that pressure, right? Because there's always that saying, if you don't deploy it, then it might not come back, right? And so, but I think the best investors, like I talked to Rhett Trees once, and I think he waited 18 months or something to deploy the money. But then once he got going, it was game time because there was a bunch of opportunities for him.
Yeah.
And I was like, I really admire that guy's resilience, right? Because that is tough to do. The amount of calls that guy was
Oh,
getting
I
to go,
guarantee
hey,
you, he was probably like, "Hey, man, like, woo."
yeah, yeah, I couldn't imagine that, you know?
Yeah, yeah, no, that's interesting, and the fun thing is always fascinating. It's like I've seen some of these big apartment guys too that have done like huge deals. They're still doing syndications. I'm like they haven't switched to like fund models and stuff, and they're still like doing deals quite frequently, and they're raising for each deal. And so I just I wonder why some people stick to that model and then some people don't go the fund route.
Well, honestly, it's easier. I mean, that's really what it is. Syndications are so much easier. You don't,
Yeah.
I mean, think about it. Like from the syndication perspective, you find a deal and then you just go to your investors, right? And if you have your kind of Rolodex investors that trust you and you've built an incredible relationship, I mean, you could get a deal done in 45 to 60 days,
Sure.
no problem,
Yeah.
right? Fundraising for a fund is a 6 to 12 month process minimum, right? And you've got to get a securities document. You're regulated by the SEC. You've got to set up a fund administrator to manage your money if you want to be responsible about it. It's a beast, right? It's its own little company in a way. And the reason I like it though is it does add a level of organization to deploying capital that we just didn't have with syndications, right? I'd have instances before where I'd had three deals in market. We're raising for all of them at the same time. So now it starts to look like, well, which one's better, which one's worse. And the other thing about syndications for investors is you could invest in a deal that goes sour and then that's it, that's that one investment, you're done, right? And so you in the syndications people will say that it's better for the GP because if one deal goes bad it doesn't impact the GP's returns on another deal if it went really well, and vice versa on the LP side. You could have a bad day here and a good day there, so like but to me that's very concentrated risk. So as you get bigger and you have like investors that want to give you larger checks, my argument to them is always, well, I don't, no matter how good our diligence, I can't control a tornado hitting a community in Iowa, right? That's out of my control. That's up to people, different people, right? So my thing with the fund is that you're taking industry risk. So it's like, okay, we're going to go buy in Sunbelt. We're going to buy across these different states. this could happen here, that could happen there. We'll match and diversify the risk in a portfolio. And I think that's an absolute better outcome for investors, right? You might have a deal that's very value add, consuming a lot of cash for 6 months, but it's going to deliver a great IRR. And you match that with a high cash flowing deal that has nothing but stability for the portfolio, right? And so on a blended basis, you're actually taking lower risk, right?
Right.
That to me has been the best benefit of it. You're running capital and deals in like in our case 5 to 10 properties portfolios, which makes financing easier, which makes management easier. Working capital, you can actually reduce the amount of cash per property because you can now manage it as a mini business, right? All those things I think are very accretive to the investor and the sponsor.
Yeah. Yeah. And I like that because you can buy that value add deal that, just like you said, has a great IRR after the at the end of the term. But then you
That's right.
go
Yep.
buy that super stabilized low cap rate deal that's going to, like, sort of balance out in the fund. And so I think it's
Yep.
easier for you to take those kind of risks, which really aren't risks. It's just, you're not going to pay, the cash flow is lower, but if it's a great asset and it fits in with the other stuff, I love that idea about it.
100%. No, and that's so important, right? Because, like, for example, you can have really good value add deals, but the problem with those deals, anybody will tell you, is that there's no cash flow,
Yeah.
right? So you're consuming a lot of cash. It creates a lot of value on the exit, but when you think about interim cash flows, it doesn't. It's hard to. So there will be investors that like that specifically, and then there's investors that want quarterly dividends, right? And
Right.
so you put a portfolio together. Now you can hit really good returns because you have your equal weights of both. And again, I go back to it's just risk reward, right? So value add has higher return, higher risk. Stabilized assets that are essentially just cash flowing have lower risk, lower risk matched with a slightly lower return, but you don't have to. What's there to do, right? You just got to manage it, and so you're in funds. You're always constructing the portfolio. So, like, when we get overexposed to Florida, then we just stop buying in Florida in the fund. We
Mm.
want to buy in other states because we just feel that geographically that's too much concentration, no matter how good we think Florida is.
Yeah.
And you're constantly doing that balancing act.
Yeah. Yeah. Well, dude, I love it, man. I mean, we could sit here and talk and go back and forth forever because I love talking about this stuff, man. I love it.
Well, you're a fun guy to talk to, Derek. Honestly.
Likewise,
Yeah.
man. Likewise, likewise. Is there anything else that you want to leave our listeners with before we head off here?
No, no. I think. I mean, I'm sure everybody that listens already watches everything that Derek does. I think I'm
For
a big
better or
fan
for
of what
worse.
you do. Hey, yeah, exactly. I only know it for the better so far, so we'll see. But no, Derek. I mean, I just appreciate you having me on the show. If anybody ever wants to reach out, learn more about what we do or what you do, always do. I'm sure you'll provide contact information, all that. But no, man, I'm a big supporter of what you do. So I was glad we were able to connect finally a couple months ago, and glad to be on the show.
Yeah, yeah, same, man. Same, man. I'll have to have you on again, man. We'll have to change the show every little bit. I have, Hansel on, smart guy. We can talk about, the market stuff. I love it, man.
Whenever you want to, man. Honestly, I love this stuff like you, so we can nerd out for quite a bit.
Yeah, yeah. Well, cool, Hansel. Again, I appreciate it. If you drop,
Yeah,
I don't know if you sent like links and stuff. We can drop those in the show notes for Core Communities, your website, so you guys can go check that out. I'm sure.
yeah.
Do you have any open funds right now that you're raising capital for?
Yeah, no, we're in market with. I guess I should have mentioned that, but yeah, we're in market with our 2024 fund. We've raised about 50% of it already. We're targeting 25 million
Nice.
in that fund. So yeah, no, if anybody ever has an interest in that, I mean, it is limited to accredited investors, but we're still in market with that. So yeah, happy to provide materials or anything on that structure. And our goal is we'll always be in market with a fund at least every 18 months.
Hmm.
This will be our second fund, and it'll end. I think in November 15th is our last day for capital commitments.
Yeah.
So,
Cool. Cool. Well,
and
Hansel,
Derek's fund will be coming out in 2025.
we'll see. Yeah, man. We'll see. We'll see. We'll see. All right. Well, thank you all for watching the MHP show and tuning in. We have a new episode every week, and we will see you all next time. Peace.